Thinking Byzantine here, and today we'll be talking about AMC. Now before we get into this video, I'd like to say that I'm not a financial advisor and this is all my own opinion, so please do your own research before entering any type of position. Now with that out of the way, let's jump right into this video. AMC, the sister meme stock to GME or GameStop. So what do I think of GME? Well, to be honest, there's two ways of looking at this. Or I guess you can say three, and I guess I'll name them to you. The first way you can look at AMC is as a fundamental play. With the second way as a swing trade. And the third way as the short squeeze. Now, most people who click on this video will want to know about the third scenario, but I'm thinking I'm going to focus more on the fundamentals. And I'll probably address the other two a bit later, but I don't think that'll be the primary point of this video. So I guess we should start with the second one, as that's the quickest one. So the reopening play. Well, to be honest, that play has long expired. So basically, the reopening play was to buy stocks that were heavily impacted by COVID, like the CCL, which is Carnival Cruises, AMC, and airplane stocks or airliner stocks, I guess, like Delta or American Airlines and all that. And these stocks have seen quite a swing from their COVID lows to now, and you can see here it swung from as low as $1.98 on January 5th to as high as $62.55. So the swing play that I think is pretty much over, or COVID reopening swing play, I think that's over for this stock. So it's not very viable at this point since the swung already happened. So that leaves us with the fundamentals and the short squeeze, Wall Street bets, meme play, or position, or whatever you like to call entering or exiting a position. But let's start with the fundamentals. So we'll take this is what Google has, their quarterly financials. This is from March 2021, so we're around 3 or 4 months out, because today is July 25th. So this is definitely outdated, as financials are snapshot at the moment. So I don't know what AMC's current financials look like. So we'll just take a look at their Q1. So based on this snapshot, we can see the revenues are down year over year, but that's not a really fair comparison, as Q1 2020 had January and early February, which were parts of last year where these movie theaters were not fully shut down. So perhaps not the best comparison, or I guess you can give them the benefit of the doubt when it comes to year-over-year revenue. So pretty much all this is a bit useless, I guess. But if we just look straight up at the facts, they're burning money. Their net income is over negative $500 million in the hole. Their EPS is negative, and their net profit margins are negative, to say the least. So just based on these financials, AMC's earnings are quite abysmal, to say the least. But let's take a little in-depth look. So let's see, net cash used in operating is negative $300 million for the quarter. Free cash flow is also negative. So for those who like to do free cash flow type of calculations, keep that in mind, that the negative cash flow will heavily impact your projections. But I want to see, there it is. So they issued $500 million of 10.5 first lien notes due in 2025. So this will definitely impact AMC's revenue, as they're going to have to, or I guess I should say profits, as they're going to have to pay the interest on these loans, which is not that good. It makes the stock look less unattractive, as the more debt you pile into the company, the more you siphon away those profits. And as you can tell, profits are very important to companies in general, but there's a reason why they had to do this. Why they had to do this debt offering in the first place is mainly because they had to, in order for this company, like, if we look at their quarterly financials, you see they're burning hundreds of millions of dollars, so they had to do it to keep afloat. But they were able to raise money in a way that may not be the most beneficial to the shareholder, which is share dilution. So basically, the company offers more stocks and they sell it out, and that just dilutes the shareholder. I don't say diluting is necessarily bad, depending on what they did with the money. Like, I'm guessing some of the money that they used went into keeping the thing afloat. And if we look here in July of, I'm guessing this is 2020, they reduced the principal amount by 55 million. Right here. Let's see, reduced interest by 120 million, extended maturities on 1.7 billion dollars of debt until 2036. So they're doing some financial engineering to keep this company afloat, and they're paying back a bit of their debt. And I'm guessing some of that money was used to pay back debt. So AMC on June 23rd tried to have a vote to issue more shares. I'm not sure if more shares will be issued, but the fact that they still have to do this is indicative on the company's performance, and this is after the Q1. So the fact that this was on the table means that AMC is still suffering a bit. And let's see, from January, May, and June 2021, they were able to raise $2.5 billion, which I guess keeps the companies afloat. Like I said earlier, pay back debts, or if they're going to be very aggressive, they could do what they did here, which is actually acquire theaters and try to expand their revenue base. So basically, this article by Parkev Tanatovian, I hope I said his name correctly, Parkev Tanatovian, from the Motley Fool, basically reported that AMC has made a deal for the Grove and the Americana brand theaters, which are theaters in LA, which are some of the higher grossing ones in LA, and LA is a pretty big moviegoer, market, so that could be a net positive down the line. So there's some hope for AMC, as they're still trying to make moves to generate revenue. They have done some things, like I mentioned earlier, pay back debt, extend the maturities to keep it afloat. But even then, this evaluation at $18.5 billion from a fundamental standpoint, with these revenues, it's hard to justify this. So from a fundamental standpoint, I would not buy AMC. But there's also the short squeeze meme stuff going around, and still holding up strong. I bet if you go to Wall Street Bets right now, you'll probably find a thread or two about AMC, or something about shorts being needed to squeeze, or something along those lines. But we'll just take a look at some data I found real quickly about AMC shorts. So, according to Market Beat, this is June 30th data, so a bit outdated, so this is all lagging data by around a month. So if you're going to do this play or research this short squeeze thesis, you're probably going to need to find data that's more relevant or more up to date than what I'm currently looking at. But from what I can see, that shorts have covered from change versus previous month, and floats in terms of short percentage rate, like how much of the float is short, it's only around 15%. So maybe you could squeeze it up a bit, but I'm not sure because short squeezes, they're like you can predict them. Like I think you could have predicted the GME squeeze, like uh, what's his name? It's the kitty trader. No, that's his YouTube name. Deep effing value. Yes, that's his Reddit name. Predicted and done that, but short squeezes, they're like they can. You can say that a stock should short squeeze, but it's hard to predict when it will occur. Like I believe deep effing value was in GameStop since at least 2019, if I remember correctly. So, but short squeezes, in my rely on momentum and the ability of people to bid up the stock high enough so that shorts are forced to cover or margin called, or they're down to position so much that they close, and which causes the stock to go up because they had to buy at a higher price than what they shorted for, and that sort of happened right here. It was $12.64 on May 19th, and over a course of around a 2-week period, AMC peaked at $62.55, but it just momentum just fell off. You can tell here, like it tried making another attempt here at reaching, I guess you can call it the second peak of $60.73 2 weeks later, but from there on it just lost momentum, and there's a bit of psychology to a short squeeze, or because people, they want to see movement, and if they see a stock that's just been plateauing for close to around a month from here to here, and they have a lot of profits, like if they bought here, they're sitting at around 300% profits by the end of June, then they exit their positions because they made a lot of money. As simple as that. And then the stock just fades. And it's faded around 30-ish, a bit over probably, from its high to now. And you can see this pattern earlier when it first made a big parabolic jump, around 300 percentage points there too, when GameStop was undergoing their squeeze. As you can see here, it just lost momentum and then it faded a bit. See, around 70% loss right there. So, could AMC short squeeze? Possibly. Because I don't know any, because like I said earlier, it's hard to predict when and what happens, like when and how a short squeeze would happen, but there is a possibility, of course. But does it make sense to buy it now, though? Its evaluation from a fundamental standpoint, it's pretty bad, to say the least. Just based on what I'm looking at here. And if you're trying to buy it now for the short squeeze, you gotta weigh your risk. And from what I can see, like maybe if somehow another short squeeze happens, 3x's, maybe. But at the same time, it could fade down probably into the low 10s, maybe low teens, maybe. It's hard to predict, but that's what you have to think about. The risk rewards. Is buying AMC right now worth the risk? In hopes that another squeeze will happen. Well, in my opinion, or guess what I would do is just keep watching, because this, like, would just keep watching, like I said, and just observe, because this is an interesting story. GameStop is interesting, but I don't think I want to be a part of it. You could if you want, but just be careful with this stock. I mean, if we look at a competitor like Cinemark, their valuation is around $2 billion, and these earnings look nearly identical with AMC's. Their revenues are in the hundreds of millions. They're losing money, negative EPS, all that. And if we look at their balance sheet, well, they have a lot of long-term liabilities and short-term liabilities, but based on this balance sheet, their total assets at least cover all their liabilities, so their current ratio is a bit over 1, but either way, Cinemark, AMC, they're still hurting from based on these snapshots. And in the long term, that you have to think about streaming, because HBO, Netflix, Apple TV, Amazon, they're having movies on their streaming services, and HBO has been releasing their movies at the same time as on the box office. So I guess all these points can be added onto the fundamentals of AMC and Cinemark as bearish trends. But I guess the positive is from that people may like the movie experience and maybe they'll return, but that's a gamble. AMC is a gamble. That's the best way to summarize this, because fundamentals don't hold up. The swing trade or the reopening swing trade is practically played out, in my opinion, which leaves the memery, the Wall Street bets, and that's a gamble. It's in the name, Wall Street bets, gambling. See the connection there? Well, if you're into AMC, just be careful. If you're entering AMC, make sure you have a clear goal. Just so, let's say it does squeeze to $60 again, and your goal was $60, you sell out. Because there's some people in GME who did not sell when it was hitting $400, and then they held it all the way down into the $100. So just have a clear plan and be careful out there. This is Thinking Byzantine, and have a good night.